All right, good morning, everybody. I am back filming at work, right? My full-time job, because such is my time right now. My name is Daniel Young. I'm the owner and founder of Adapted Perspective and the Adapted Perspective social media platforms. And I'm back to talking about financial or financial means or financial strategies. So this is an unedited video, like you just heard, and hopefully you don't hear anything in the background. I am not a financial advisor. I am a financial strategist, and I don't speak like the herd. So if you've seen any of my previous videos, you know that I love strategy and targeted strategy. And that awareness is key, because I'm going to keep sifting through these financial means using our investment strategies along with some everyday down to earth common sense. So it's not my purpose to slander anybody. I'm hyper aware and very interested in separating the good from the bad when it comes to financial advice, because none of us wants bad financial advice as we navigate our finances. So if we head back to the Pinterest page, let me get us back there. Let me get y'all back there. Share screen. Here's the main Pinterest page. Save version. We're operating off this meme board. Towards the bottom, we get this, which it used to be a link, but it's not. But the link took you to somebody's blog where they bragged about gaining 2 to 4% in dividend income, which is atrocious. So instead of using their blog, I'm using the Dividend King list on the Motley Fool. And from my perspective, it's called Fool for a reason, because it's just as bad. So if we look at genuine parts and we come to the online investor, you can search by code. You get this long history of dividends. Click on the graph and it takes you to this page. If we come back to the dividend list on the Motley Fool website, you get this 68-year streak of increasing dividends. Now that sounds great. Sounds fantastic if you want a bigger graph. So the graph here is just 5 years wide. It pays about 2.8, 2.9, which is still honestly just really shitty. If you believe the Fed's nonsense about them controlling inflation in a good year at 2%, then you need to wake the hell up. The Fed lies about the data. The Fed cooks the data. So on a good year, inflation sits at 4%. On a bad year, inflation sits a lot higher. So on a standard year, your dividend income is losing money. It's not even break even. But if you want a wider angle, if you bought genuine parts back when they started, well, heck, you have a fantastic return. You have a fantastic dividend in comparison. If you bought genuine parts recently, you get that 2.8% dividend. That's just not great. Now, in theory, back when you bought genuine parts in 1972, you had the overall same payout ratio. You just paid a lot less. The dividend was a lot less, but it still paid about 2.8. Companies tend to keep the same payout ratio. So as their cost per share goes up, their dividend mirrors that, and it really just stays about the same dividend payout. The difference is if you bought it back here, you have the same buy-in price, and your dollar a share right now per quarter is crushing it compared to when you first bought it. But that's not most people. Most people are buying it now because they see the Dividend King list. So it's currently $1 a share paid quarterly. You get it 4 times a year. So it's $1 times 4, $4 a year, divided by this gives you about 2.87. So instead of buying a single stock, what if you could get a better deal? And you're not getting a discount, and you're getting a crappy dividend, and you're getting a quarterly dividend. What if you could get it at a better deal? So if we look at our closed-end fund list, ETB that sits here owns genuine parts inside their portfolio. Currently, ETB has a significantly discounted fund. So you're getting a better deal than normal. Historically, their fund sells for more than it's worth. Currently, it's discounted and you get a decent discount. It also gets a decent yield. So if we took the same amount of money, so it's about 139. Let's see. Yep, 139.65. So we're not going to get a full 10 shares. I mean, that would be that. But if we went 9 shares, you're under what the cost of 1 share is for just genuine parts, but you're getting a lot greater dividend that's paid monthly. But buying into this also gives you access to a lot of other companies. And it's also, say as my notes, it's all stocks. But the question is, in the grand scheme of the market, should you be investing in stocks right now? And that kind of goes with your overall strategy and where you think the market is going. Currently for us, we're investing in bonds. If we're buying anything, and we're not because we're currently in the greed cycle. You look at the CNN Fear and Greed Index, we're currently riding the next greed wave when stocks are higher, when bonds are higher. So the Fed cut rates behind the curve, the Fed cut rates, everything went up a little bit, right? If the Fed cuts rates again, everything will go up a little bit. So in this market, bonds are the better deal long term. But if we actually get to recession, which you've got different people forecasting different things, soft landing, no landing, hard landing. Generally, when you have a greater interest rate cut over time, you end up with a recession, and the labor data suggests that, although they're cooking the labor data as well because they're trying to sell you on how good you hope the economy is, as opposed to how good the economy or how bad the economy actually is. And that dock worker strike points to that as well. So rising inflation, rising overall cost of everything, interest rate cut, followed by recession. If we hit true recession, whether it gets labeled that or cooked data, we smooth over that. If we hit recession, stock values will go down, bond prices will continue to go up. And once we hit that fear territory, where we're currently in greed, if we hit recession, it's going to switch all the way back to fear or extreme fear. Stock values will go down, dividends will go down, or pending company dividends will stay the same. But when stock prices go down and bond prices continue to go up, and we hit fear, and then people start pumping more money into bonds, causing those prices to go up, stocks will drop further, and that's the best time to buy stocks. So if you're going to play the dividend game in the sense of you're looking at dividend champions and dividend kings, that's never been my jam. You're not getting a good deal. You're paying full price and getting a crappy dividend. And it's very risky in the sense that it's just one stock. But if you can use the current market to get the best absolute deal that's closed-end funds, you get a discount. You can determine when it pays you, monthly, quarterly, semi-annual, annual, or never, which would just be foolish in my stance. But you can optimize the discount, get a crazy great price, get a monthly dividend that pays 8%. Really, our priority is 9% plus. So if we hit that true scenario, right, bonds up, stocks down, fear territory, bonds go up more because people put money, newbie investors crank money into the market always late. They poorly time the market, and they play the current market hoping for retirement gains, but they're not going to play it long term. They're new, they're shaky, they're uncertain, bad strategy. So when bond prices continue to go up and stocks go down, and we hit fear territory, that's the time to buy into the market. And that's the time we'll be looking to buy into the market and specifically targeting stocks for the current market, knowing how things will go long term. So if you like the advice, if you like the feedback, if you like the commentary, by all means, please consider subscribing to my channel. Hit the like button because it really does help push out videos. And then head over to Facebook and check out my group there called Navigate Your Finances, where I get into the full 12 steps of financial freedom. So whatever you have for the week, I hope it goes well. Whatever you're doing in the market, I hope you know your strategy. And I really do. I hope you're using today's market and looking 20, 30 years down the road of where you hope the market will go. And I get that sounds crazy, right? Nobody knows how tomorrow's going to go. But if you can use today's market and look in the future of where you think the market will go, your strategy will improve your outcome. Investing willy-nilly, like a newbie investor, is not going to go well. You'll pump money into the market at the wrong time just to be fearful and pull money out, and it'll look like this. And you don't want that. So if you can put money in at the right time, target the right items, know what you're doing and why, you'll end up with a much better overall strategy and a much better overall outcome. So I wish you a great week. I will see y'all in another video. Bye-bye.